Imagine you wake up tomorrow morning, check your phone like you always do, and the first thing you see isn't your emails or your texts, it's a news alert. And it says something that makes your stomach drop. You open your brokerage app, your portfolio is down 18% overnight. Not because of a bad earnings report, not because of inflation numbers, because of something happening 6,000 miles away that you had absolutely zero control over. And in that moment, you realize something that most people only realize when it's too late. You never actually protected what you built. My name is Smith, and I spend way too much time thinking about geopolitical risk and what it does to your money. If you're someone who works hard, saves diligently, maybe has a 401k and some index funds, and you've been watching the news lately feeling a low-key anxiety about what any of this means for your financial future, hit subscribe and give this video a thumbs up, because what I'm about to walk you through could be the most important financial conversation you have this year. Let's talk about gold, and not in the way your weird uncle talks about gold at Thanksgiving. I mean the real, documented, historically verified reason why physical gold has been the go-to move for serious investors every single time the world starts looking like it does right now. And right now, the world is looking a little crazy. Here's the thing. Most people think investing in gold is something that conspiracy theorists do. They picture some guy in a bunker surrounded by coins. And I get it. That image has done a lot of damage to what is actually one of the most rational, evidence-backed financial decisions you can make during a specific set of economic conditions. And those conditions, we are living in them right now. Let me give you some context. As of 2025, global military spending hit a record high of over $2.4 trillion, according to the Stockholm International Peace Research Institute. That's the highest it's been since the Cold War. You've got active conflict zones in Eastern Europe and the Middle East, Taiwan's straight tensions that keep defense analysts up at night, and a geopolitical fracturing between major economic powers that is fundamentally rewiring how global trade works. Now look, I'm not here to predict a third world war. I'm not a military analyst. What I am is a finance educator who understands what historically happens to paper assets, stocks, bonds, fiat currency, when geopolitical risk spikes. And what happens is not pretty. Here's what most people don't realize. The financial system as you experience it every single day is built almost entirely on confidence. That's it. Your dollars are worth something because enough people believe they're worth something. Your stock portfolio is worth something because there's a functioning market that believes in the companies behind those shares. The moment that confidence gets shaken, really shaken, not just bad CPI numbers shaken, but are we heading into something historically serious shaken? Assets that are backed by confidence alone start to crack. And the assets that are backed by something physical, something real, something that has held value for 5,000 years of human civilization, those don't crack. They tend to go the other way. This is where it gets interesting. Let me show you the math because I want you to actually see this, not just take my word for it. In 2001, gold was trading at around $250 an ounce. That same year, the September 11th attacks happened, the U.S. entered 2 wars, and global uncertainty absolutely spiked. By 2011, gold hit $1,900 an ounce. That's a 660% return in a decade. The S&P 500 over that same period, it was essentially flat, and that includes a full market crash in 2008. Now, I'm not saying gold always outperforms the market. It doesn't. Over long, peaceful periods of economic growth, equities win. That's the deal. But here's the key insight. We are not in one of those periods right now. Let's look at more recent data. When Russia invaded Ukraine in February 2022, gold jumped roughly 8% in a matter of weeks. When the Israel-Gaza conflict escalated significantly in late 2023, gold hit all-time highs near $2,100 an ounce. And by 2025, gold was regularly trading above $3,000 an ounce, with institutions, not conspiracy theorists, not doomsday preppers, but Goldman Sachs, JP Morgan, and central banks around the world all increasing their gold positions.
The World Gold Council reported that central banks bought over 1,000 tons of gold in back-to-back years, which was the highest central bank buying streak in recorded history. Think about that. The same institutions that manage the financial system you rely on are quietly, methodically loading up on gold. That's not a coincidence. That's a signal. Now you might be thinking, okay, Smith, but I can just buy a gold ETF. I don't need to actually hold the physical stuff. And look, I hear you. GLD, IAU, these are legitimate financial products, and there is a place for them in a portfolio. But here's where I need to slow down and really explain the difference, because this distinction matters enormously, and almost nobody talks about it clearly. When you buy a gold ETF, what you actually own is a paper claim on gold. You own a share of a fund that says it holds gold, but you don't hold the gold. You can't. It's sitting in a vault somewhere, managed by a financial institution, subject to counterparty risk, subject to the functioning of the financial system, subject to the exact same fragility that physical gold is supposed to protect you from. Think about it this way. If you owned a claim ticket for your car in a parking garage, and then the parking garage went bankrupt, your claim ticket becomes worthless. You don't have your car. The claim ticket is not the car. A gold ETF is the claim ticket. Physical gold is the car. Here's the thing about geopolitical risk specifically. It is the one scenario where counterparty risk becomes most dangerous. In a financial crisis like 2008, the system gets stressed, but it doesn't fully break. The government comes in, prints money, backstops institutions, and the paper system holds together. But in a full-blown geopolitical crisis, in a scenario where supply chains get severed, where sanctions create financial isolation, where entire economies get cut off from SWIFT, in those scenarios, the paper financial system is exactly what's at risk, and paper gold goes down with it. This is why physical gold is different. It has no counterparty. Nobody has to honor it. Nobody has to process your transaction. Nobody has to be solvent for it to be worth something. You hold it, you own it, full stop. And that characteristic, zero counterparty risk, is precisely what makes it uniquely valuable in a world that is starting to look increasingly fragile. Let me give you a psychological framework for thinking about this, because I think money decisions are almost always psychological before they're mathematical. There's a concept in behavioral economics called loss aversion, which basically means that the pain of losing something is roughly twice as powerful psychologically as the pleasure of gaining the same thing. Losing $10,000 feels about twice as bad as gaining $10,000 feels good. And what this means practically is that most investors make their worst decisions when losses are already happening and fear is running high. You panic sell at the bottom, you rush in too late at the top, you ignore risk when things are good, and you overreact to risk when things are already bad.
The time to protect your wealth is before you need the protection, not after the headlines are screaming, not after the portfolio's already down 25%. Right now, when things still feel manageable, when you can be strategic rather than reactive. This is what separates the investors who come out of major crises stronger from the ones who spend years rebuilding. It's not smarts, it's timing and psychology. Here's what most people don't realize about the gold market specifically. Gold doesn't just protect you during a crisis, it actually tends to give you optionality coming out of one. Here's what I mean. In a major geopolitical event, a significant market correction, when stocks are beaten down, when real estate prices have dropped, when opportunities are everywhere, the people who hold physical gold have something incredibly powerful. They have purchasing power that survived the storm. While everyone else is trying to recover, you can be deploying capital into undervalued assets. Gold isn't just insurance, it's a strategic reserve. Let me walk you through what a practical allocation actually looks like, because I don't want this to be theoretical. I want you to be able to act on this. Standard financial guidance, from Ray Dalio's all-weather portfolio to more conservative advisors, suggests somewhere between 5 and 15% of a portfolio in gold, depending on your risk tolerance and your view on macroeconomic conditions. In a period of elevated geopolitical risk, like right now, many institutional investors are toward the higher end of that range. So let's say your total investable assets, retirement accounts, brokerage accounts, savings outside of your emergency fund, total $200,000. A 10% allocation means $20,000 in gold. At today's prices, around $3,000 an ounce, that's roughly 6 to 7 ounces of physical gold. That's not a bunker full of coins. That's a very manageable position that you could hold in a small home safe or a bank safe deposit box. Now look, when I say physical gold, I want to be precise about what that actually means in practice, because not all physical gold is created equal for investment purposes. The forms most recommended for investors are gold coins minted by recognized sovereign governments, things like the American Gold Eagle, the Canadian Gold Maple Leaf, the South African Krugerrand, or the Austrian Philharmonic. These are highly liquid, universally recognized, and easy to verify. The other common form is gold bars, typically from accredited refiners like Pamp Suisse or the Perth Mint. Bars tend to have slightly lower premiums over spot price, meaning you pay slightly less over the actual gold value, but coins tend to be more liquid and easier to sell in smaller increments. What you want to avoid is numismatic coins, collector's coins, where you're paying for rarity and historical value rather than gold content. Those are a different market entirely, and they behave differently. For pure wealth protection purposes, stick to bullion, standard coins or bars from reputable mints and refiners. Here's something else I want to address directly because I know it's in your head. You're thinking, Smith, gold doesn't pay dividends, it doesn't compound, it just sits there. And you're right, gold doesn't generate income. A share of Apple pays dividends and has growth potential. A rental property generates monthly cash flow. Gold does neither of those things. And in a period of economic stability and growth, that's a real cost. The opportunity cost of holding gold during a bull market is real. But here's the reframe. You don't insure your house because you expect your house to burn down. You insure it because you can't afford for your house to burn down without a backup plan. You don't think of your insurance premium as a terrible investment just because your house didn't burn down this year. That premium bought you something valuable: certainty, stability, the ability to sleep at night and take risks elsewhere in your life, knowing you have a floor. Physical gold in a well-constructed portfolio plays exactly that role. It's not trying to be your growth engine, it's your floor. And right now, given everything we're watching unfold globally, having a floor is worth a lot. Now you might be thinking, isn't it too late? Gold is already at $3,000 an ounce. Am I buying at the top? And this is the objection I hear most often, and it's worth taking seriously. First, let me point out the irony. People almost never ask this question about the S&P 500 when it's hitting all-time highs. They just buy index funds regardless of price because they've internalized the idea that for long-term wealth building, you don't try to time the market. But somehow, with gold, they want to time it. And that's backwards, because gold, unlike equities, isn't priced on future earnings expectations. It's priced on present fear, present dollar weakness, and present geopolitical risk. All three of those things are pointing in the same direction right now. Major institutions, including Bank of America and Goldman Sachs, have published research in 2025 with gold price targets in the $3,500 to $4,000 range, not because they're gold bugs, because the macroeconomic and geopolitical conditions support it. And historically, once a gold bull run driven by genuine geopolitical uncertainty gets momentum, it tends to run significantly further than most people expect before it reverses. This is where it gets interesting from a psychology standpoint. Most retail investors end up buying gold too late, after a crisis is already fully visible and prices have already spiked violently.
The sophisticated move, the move that the institutions and the high net worth families are making right now, is building the position gradually before the urgency is undeniable. Dollar cost average in. Buy a coin a month. Build your position systematically over time. You don't need to go all in tomorrow. You just need to start. Let me leave you with this. There's a quote often attributed to Warren Buffett, and I know, bringing up Buffett in a gold video, the irony is not lost on me since he's famously not a gold fan, but there's a principle he talks about that actually applies here perfectly. He says, the price you pay determines your rate of return. What he means is that the time when everyone is confident, when nobody is scared, when the financial news is positive and portfolios are green, that is when the price of protection is lowest. When fear is high, when uncertainty is obvious, protection becomes expensive. The time to buy insurance is before the storm, not during it. We are in that before moment, not before everything is fine, before everything is clearly not fine. We are in the uncomfortable middle, where smart money is moving quietly and decisively, and most regular investors are still in wait-and-see mode, hoping the geopolitical situation somehow calms down on its own. Here's what I want you to do this week, not eventually, this week. Sit down and look at your total investable assets. Calculate what 5 to 10% of that number looks like. Go to a reputable dealer, Apex, JM Bullion, the U.S. Mint directly, and just get educated. Look at what a 1-ounce gold eagle actually costs. Feel the reality of that as an actual, concrete, physical step you could take. And then ask yourself whether that amount of your portfolio, being in something that has no counterparty risk, that is preserved wealth through every war, every currency collapse, every empire rise and fall for 5,000 years of human history, whether that feels like something worth having. Because at the end of the day, the goal isn't to get rich off of gold. The goal is to make sure that whatever you've worked for, whatever you've built, survives whatever comes next. And in 2026, with the world looking the way it does, that goal deserves to be taken seriously. I'll see you in the next one.